Okay, so the formal presentation is not particularly complicated because mathematically speaking, you could do this as complicated as you want. You can go very, very deep in the weed, but we are going to try to survive, and so do it not too complicated. Before I start, let me just show you one thing that I forgot to, sorry, I forgot to open Blackboard here. Just a second. Okay, if you go in the UTS Online for this week, and then you go at the bottom where it says for your own interest, remember that for your own interest is all these additional resources if you want to understand or read more on a topic that are not necessary for the exam. If you go here, you will find a link to a company called New Frontier Advisor. Okay? Now, resampling was invented by a guy called Michaud, Oliver Michaud. I think it's Oliver. And then this guy created an advisor company called New Frontier, and they also patented resampling. Okay, so first of all, I just want to avoid, I don't want to go to jail, so I'm just going to say front that they have a patent on this thing. Now, I don't know how you can patent a Monte Carlo simulation, because it's like patenting 2 plus 2, and you are the only one in the world that can do 2 plus 2, so it's not totally clear to me why they can patent a mathematical formula, but apparently there is a patent. So there is a famous case that they went after a finance professor who published an article on resampling, so I would like to be safe. But if you want to read more about resampling, you go to New Frontier and research articles, and they have a lot of stuff. They keep publishing on resampling because, of course, resampling is their key product. Okay, and so, for example, they have articles on Markowitz versus resampling. Then I think that they have an article where they explain Morningstar versus Michaud. So actually, the resampling that they do is slightly different from the resampling that Morningstar does. There is a technical aspect, technical detail that is different. Anyway, so this is just for you if you, Richard Michaud, not Oliver Michaud. Just in case you want to go deeper into the weeds about resampling. As you can see, the logo of the company is a typical graph that comes out of a portfolio optimization, so it's not particularly original. Okay, so having said that, resampling. Now, if you run a normal Markowitz optimization, okay, there is a problem. The Markowitz optimization implicitly considers that your forecasts are correct. And so if you say, look, the expected return on the US stock market is 8%, and the stock market has a volatility of 20%, what the Markowitz optimization understands is that your market has a volatility, 20% of volatility. So it means that will go up and down. But on average, will go up 8% per year. And so if you are invested long enough, you're going to get your 8% per year. Now, if a market has a low volatility, you go up very smoothly. If a market has a high volatility, you go up a bit bouncy, but you, on average, go up 8% per year. So if you stay invested long enough, you're going to get your 8% per year. That's what Markowitz think, what is implied in the model. Now, rather than discuss it theoretically, let's look at a numerical example. This is an old example. You can see how old it is because there is still Equity Italy. So I did this example when I was back in Italy. I don't think that many people outside Italy have an asset class called Equity Italy. But what you have here are a bunch of asset classes and then my expectation in terms of volatility or standard deviation and expected return. These expectations are rather more or less okay. They are actually not super different from what we have today. I think the equity asset classes are a bit too optimistic for where we are now. But, more or less, it makes sense. If you do the optimization, you do the frontier, that is the frontier with 50 portfolios on the frontier. Now, as we know, the graph with the frontier doesn't really tell us much. Let's have a look at the frontier composition. We plot the composition and we see this. Remember that this graph, the way you read it, is that the number of the bottom is the portfolio. So portfolio number 50 is the last portfolio here. Portfolio number 1 is the first here. Okay. And the colors, we read the composition on the vertical axis. So if I ask you, what is the composition of portfolio number 1? Well, we look here. Portfolio number 1 is basically 100% the dark blue area that is cash. Cash means money markets or short-term bonds. Okay. If I look at portfolio number 15, that will be somewhere, I guess, here. Portfolio number 15 has a composition that is 30% shorter bond, roughly 35-40% long-term bond, then, bond, I think the light blue is bond euro, then there is this very light blue one, that is another 30%, that is bond emerging market, etc. Okay, so that's how you read it. Now, imagine that you are a portfolio advisor, and you need to convince a client that they should buy a portfolio on this frontier. From the marketing point of view, and I'm saying marketing without any negative connotation, so for the relationship, from the point of view of the relationship with the client, why is it difficult to sell this frontier? What is weird about this frontier? What is weird? They say, okay, no, my grandfather will not be, or my grandmother will not be very happy to invest in this frontier. Why is that? This is not really finance, it's more common sense. What is?
To get the highest return, you have to invest in 100% in emerging markets.
So, first problem, if I look at the equity component of the frontier, is heavily dominated by equity emerging markets, by a single asset class, and by the way, an asset class that is considered to be risky. So that's the most striking aspect. There is a second striking aspect that even if you look at the medium risk portfolio part of the frontier is also dominated by emerging market, in this case bond emerging market. Okay? Now, why does this happen? Let's focus on the equity, because if you look at the equity, basically here there is no US. US is this little orange sliver here. There is no US. There is a tiny little bit of Japan. And then the rest is all equity emerging market. Why something like this would happen? Well, if you look at the expected return, it's pretty clear. Because equity emerging market has an expected return that is either 1 or 1.5 higher than the other equity markets. With the volatility, the DS is a little bit higher, but not that much. If you compare equity US with equity emerging market, yes, equity emerging market has 0.8% of volatility more, but has basically also 0.6% of return more, and that's much more important. Okay, so since my expected return on equity emerging market is so much higher than on the other equity markets, the portfolio optimization says, why should you invest in an asset class that has a return of 8%, where you can get 9% with basically the same risk. Okay? And the same, it's even stronger for bonds, because if you look at bonds, yes, it's true, bond emerging market has a bit of a higher volatility, but have an incredibly high return. Compare it to bond US. Even lower volatility and much higher return. Okay? So the idea is bond emerging market, but even more strikingly, equity emerging market have such a high expected return that they dominate the frontier. Okay? Again, imagine talking to your client. And your client is looking at this and says, I don't really like having 80% of my portfolio in equity emerging market. And you say, but look at our expectation. The expectation is higher. So Markowitz said, don't worry, just do it. Okay? Don't worry, just do it. So what would make you uncomfortable investing here? The expected return says it makes sense. Why we say that's not enough? Somebody said, look, yeah, it's true. We are betting the farm on equity emerging market, but the return is higher. So why we say it doesn't matter? Why we say that's not good enough? That's not a good reason. What makes us uncomfortable? Any idea? Well, because you have seen the methodologies that you are looking at, like dividend discount model, CAPE, etc. These numbers are just basically guesses. So is it really so much better having a 9.25 expected return versus 8.4 when on average you are wrong by 2 or 3 points? Do you see the point? Sorry. Okay, so the issue is that this methodology, the Markowitz model, it usually focuses the portfolio on very few asset classes that have a higher expected return. That's why, yes, nominally we have 15 asset classes, but really just 3 or 4 matter here. The others don't matter. Okay? Now, there are 3 things that are particularly problematic. 3 problems. One is long-term structural breaks. That basically means our forecast may be wrong. Okay? That 9% may not be representative of the long-term return of that asset class just because we are wrong. We got the expected inflation wrong, we got the growth of dividend wrong, we just got it wrong. Okay? So, as we said, long-term structural break means the structure of the economy changes drastically, so we are using a growth rate of dividend of 6% because that's what happened in the last 40 years, but in the future it's no longer 6% because something has changed in the economy. Okay, so the first problem is this idea of structural break, so we could just be wrong in our expectation. Okay, but it's not only that. Now, let's assume that for some miracle, we get a sort of a time machine, we can jump ahead 10 years, and we can look at the effective return. So let's assume that these numbers are correct. Okay? That we can jump 10 years in the future or 20 years in the future, and we see the effective return. So now we are in the world that doesn't exist, but let's imagine that this is exactly the long-term return of these asset classes. Are we safe? Not really. Yes, we can rule out structural breaks. This is no longer a problem. But there is another problem, and the problem is the sampling error. Sampling error is a bit of a statistical terminology. What does it mean? It means that even if I'm sure that the long-term return is 9% or whatever, what happens if my investor doesn't stay in for the long run? Okay. I think that in the teaching note, you will find a graph, something like this, that is not particularly sophisticated, but it's just to give you the idea. Time, emerging market, this is time 0, this is time 10, okay? And let's assume that since we were able to travel to the future, today the value of the market is, let's say, 100, we know that in 10 years the market will be here, okay? Will go up, we know it. But since the market is volatile, it can go up like this, it could go up like this, or it could go up like this. Okay, we don't really know. Okay. Now let's assume that our investor doesn't have a very long investment horizon. That our investor has an investment horizon of, this would be like 4 years. Okay. Again, even if we know that the long-term return is exactly what we have forecasted, we still have a problem that we don't know how do we get there. This is called, I mean, it makes a lot of sense, purely, let's say, from an intuitive point of view. Statistically, it's called sampling error. And the idea is the following. We said that emerging market has an expected return of 9.25 and a standard deviation of 21. Basically, what we are saying is that the market is normally distributed with the mean is 9.25 and there is a volatility. Okay. Now we are going to see this more in depth next week. But basically, what we are saying, look, every year. Again, here is assuming that the long run return, in fact, is 9.25. Okay? Even assuming that, every year, you're going to draw a random number from this distribution. You know that on average it's going to be 9.25. And so if you keep playing, you're going to get, in fact, on average 9.25. But you may have a very good year where you get, I don't know, 15. And then you may get a very bad year when you get 2. Or even a super very bad year when you get -3 and whatever. Okay? So you're gonna, if you're invested for 4 years, you may get 4 good years, and so you are on the blue track, or you may get 4 bad years, and so you are on the red track. So this is called sampling error, and basically means, look, even if you know exactly the average return of your portfolio, you still don't know what you're going to get year after year. And if you only stay for a small period of time, so if your sample is small, you're going to have problems. If you stay invested for 50 years, if you're a superannuation fund that stays invested in a market for 50 years, you don't have any problem in this case because you're going to get 50 numbers from this distribution. And so on average, you will be very close to 9.25. But if you only stay for 3 or 4 years, you don't know. You can get 3 very good, 3 very bad, mixed bag, etc. Okay? Now here, I gave you an example of a distribution. Here what happened is I took the S&P 500. When I did this calculation, the historical average return of the S&P 500 was 7.1 and the standard deviation was 15.5. And then I said, okay, so let's imagine an investor that only stays for 5 years in this market. Let's simulate 1,000 possible scenarios of 5 years, and let's calculate the average return. As you can see, it's true. The average return is something around 7. So that's okay. But you may have 5 years where you get very, very lucky, and your average return is 17 or 20%. Or you may have 5 years where you get very, very unlucky and you get even a negative average return. Remember that the return on the US stock market between 2001 and 2000 and 2010 is 0. So there you have 10 years of bad returns. Okay? So these things can happen. Now, this idea of sampling error is crucial. So we need to understand it very well. So the idea is, I repeat, even if we know that the average return of the market is in fact 9% per year, we know that if we stay invested for a long period of time, 20 years, or here we say 10, 20 would be better, but if you stay invested for a long period of time, you probably will get something very close to 9% per year. But if you stay invested for a small number of times, you really don't know. Why? Well, because basically you are drawing a sample from this distribution, and if your sample is very small, only 3 or 4 years, you can get very lucky or very unlucky. Does this make sense? Okay, so that's the second problem. So we said the structural breaks. Then, even if we are correct on our long-term return, if we are invested in a small sample or a small number of years, we are going to get a sampling error. And then we have a third problem, that is the tail monster. Now, the tail problem is the following thing. So far, we always describe a market with an expected return and a standard deviation. We are basically assuming that markets are more or less normally distributed. And that's fine. But we know that even if something is almost normally distributed, you still have a small probability of a devastating event. Okay? So, I prepared this slide, as I said, 10 years ago. So this is no reference to what's happening now in Hong Kong. But you can see that if you look at the distribution of monthly returns in Hong Kong between 1970 and 2001, it's more or less normal. But you have 3 extreme events. These events are called tail monsters in statistical jargon, because these are monsters that are hidden in the tails of the distribution. So these are events with an incredibly low probability, but they can happen. The probability is very low, but if they are going to happen, they are very bad. They are sort of catastrophic events. And if you look at the real graph, we have 1 month where the Hong Kong did 73% in a month. And then you have 2 months when Hong Kong did minus 44, minus 40%. Now, usually if you do plus 73% in a month, your clients will not complain too much. So that's a monster, but it's a good monster. It's like the ones in the cartoons, like Monsters and Co. But then you have the real bad monsters, okay? That are these 2 minus 44%. Now, this is Hong Kong, it's not emerging markets, but imagine that you are invested 100% in Hong Kong. Why? Because your expected return is good, and then you get minus 44%. Boom. Your client is going to go nuts. You literally are going to have clients knocking on your doors and suing you. So that's a problem. Now, it's true that this is a problem with every asset class. Everything can collapse. It's more problematic with certain asset classes than others. In this case, emerging markets are traditionally more unstable. And what's happening now to Hong Kong is kind of an example of a market that is no longer super emerging, because Hong Kong today is a pretty big market. But still, there are elements of political instability that can create some unexpected situation, then can lead to big losses. Okay? Now, how do you protect yourself against these monsters? How do you protect yourself against tail monsters? Yeah? Okay, she says you need to diversify. That's correct. She actually says, can I find something that goes in the opposite direction? That's very difficult. You don't really need, I mean, if you could, that would be great, but it's usually quite difficult. What you need to understand is that many times these tail monsters are very specific events, like an earthquake, military instability, like, or some crazy things like what happened in Venezuela, or something that usually is very specific to a country. And so if you diversify, you kind of get rid of them. So if you move from Hong Kong and we look at Pacific ex-Japan, so basically these are all the emerging markets in the Pacific, we already got rid of 2 of the tail monsters. We got rid of the 73%, and then we got rid of 1 of the 2 negative ones. It means that out of these 3 extreme events, 2 were country-specific. They were specific to Hong Kong. The moment our portfolio is diversified, and Hong Kong only weighs like 5% in our portfolio, or 10%, we get rid of them. Okay, there is still 1 tail monster, minus 44%. This means, since this survives the diversification, it means that it's not a country-specific event, it's a regional event at least. And so the only way to get rid of that would be to diversify even more. So if I take the Morgan Stanley World, now I have no longer tail monsters. I can still have very good months, plus 15%, very bad months, minus 70%, but not minus 44 or plus 73. Okay? Again, don't be fooled by the fact that here the weird stuff is emerging market. It could be whatever, okay? So MATLAB doesn't know how to read English, so it could be, whatever has the highest expected return is gonna dominate the frontier. Now, for some reasons, usually emerging market takes that role because it's easy to have very positive expectations because they grew a lot, blah, blah, blah. But in theory, it could be something else. Okay, any question? Now, so your colleague here had a fantastic idea. Said, look, to solve this problem, we need to diversify. What we don't really want is an efficient frontier that is dominated by emerging market, either equity emerging market or bond emerging market. We don't like that. Can we get rid of that? Yes, we can. How do we do it? Well, the easiest solution would be to run Markowitz with some constraints. Okay? If you remember, we said the original Markowitz paper had no constraints, so every weight could go from minus infinite to plus infinite. We said that makes no sense, so as soon as you can, you have a computer that is decently powerful, you try to put constraints, even with Excel. If you do the efficient frontier with the solver, you can say, you can put constraints on the weights. And so we could put constraints here. We could say, for example, equity emerging market maximum 10%. Or we could say any single equity market maximum 20%. Or we could say Japanese yen asset classes together maximum 30%. So we could put a constraint. Okay, so let's see how this would work. Okay? So here, I'm going to show you a series of slides where I run the same optimization, but this time with constraints. Okay? So as you can see from the title, here there is a constraint that says no more than 80% in any asset class. Is the situation different, substantially different? No. Yes, there is a bit of difference. So if I look at really the last portfolios, now I can no longer go 100% emerging market, so I go 80% emerging market and 20% something else. So a bit better, but not that much better. And also here, if you look at the 2 frontiers, the blue line is the unconstrained one, the red one is the constrained one. Basically, you don't see the difference. They are almost the same. Okay, so let's do 60%. 60% already, I see a little bit more of diversification, a little bit more. Here, I can only do 60% emerging market, the rest is going to be Japan and the green one. Here, I see a little bit more America, a little bit more diversification in this area. Okay, I like it, so let's keep going. 40%. Well, 40%, I start seeing quite a bit of diversification. Okay? Bit messy, but there is quite a bit of diversification. And I see that the two frontiers are quite different. By the way, as you notice, the moment I put any sort of a constraint, the frontier gets worse, gets less efficient by definition, because you are constraining it. Okay, so that's 40%. 25%, no more than 25% in any asset class. Lots of diversification. Okay? 10%, no more than 10% in any asset class. That's what you get. Okay, let's look at this frontier. Is this frontier diversified? Is this frontier diversified? Yes or no? Yes, it's a rainbow. Is this frontier good? No. Why is not good? Okay, so first of all, I see here, okay, it's very inefficient. It's miles below the efficient frontier, but it's also very small. It's also is a micro frontier, is a tiny frontier. Okay, and the weird thing is that if you look at the frontier, you see something very bizarre. Look at this green asset class. It has a weight of 10% in the high risk portfolio and a weight of 10% in the low risk portfolio. Look at the red asset class. 10% in the high risk portfolio, 10% in the low risk portfolio. Look at the blue asset class. 10% in a high risk portfolio, 10% in the low risk portfolio. So it's almost like the portfolios are all the same now. Okay? Now, this is of course an artifact that I did something incredibly stupid because I only have 13 asset classes. If you give a 10% constraint, it makes no sense. But what is the financial error that I've made here? Here I made a big financial error, logic error. What is the logic error? Can you see? Anybody has any intuition? What error did I make in running this optimization? I mean, mathematically it works, but what is the fundamental conceptual error that I made? Why this frontier is very diversified, but again, nobody would buy it? What is wrong here? Yeah? Okay, she says, if you don't get much risk, you don't get enough return. That's fair enough. But more fundamentally, yeah?
If you're across all those asset classes, your brokerage charges might be ridiculously high.
Like, that's a really second, yes, but that's a really second class problem. Here there is something much, it's like somebody is running over your car with a caterpillar and you say, you scratch my side. No, the car is destroyed. So that's a second level problem. The fees here are really not the problem. What is the logic error? That I've applied the same constraint to every asset class. I've applied the same constraint, 10%, to every asset class. Let me go back to the asset classes here. Look at the first asset class, look at the last asset class. Now, all my forecasts are going to be wrong. And so I want to force diversification. So the idea of using constraint makes sense. But look at the first, look at the last. Am I equally afraid of being wrong in forecasting emerging market returns as I am of forecasting short-term returns on bonds? Am I equally worried? No, I'm not. Why? Two reasons. First of all, because as we have seen last week, forecasting bond returns is easier than forecasting equity returns. Number one. But number two, more important, if I look at the volatilities of these two asset classes, equity emerging market has a volatility of 21%, short-term bond has a volatility of 0.1%. So what does it mean? It means that if this is the distribution for equity emerging market, the distribution for shorter bonds is going to be something like this. 2%, okay? So, yes, there is still randomness, but the uncertainty is much more contained. So yes, I'm still gonna pick a random number from this distribution, but the random number are all gonna be very close to the mean, because I have a mean of 2% or 2.5 with a volatility of 0.1. Now, there is a rule that we are going to discuss next week. You are not expected to know it, but there is a rule that if something is normally distributed, a good rule of thumb is to think that if you take a range that goes from expected return minus 2 times the standard deviation to expected return plus 2 times the standard deviation, if you take this range, usually this will be from here to here more or less, you're going to get the probability that your return is within these two boundaries is 95%. So basically, if you take a range that is expected return minus 2 standard deviation, expected return plus 2 standard deviation, the probability of ending up in that range is usually something around 95%. More or less. Depends if your market is exactly normally distributed or not. But that's a rule of thumb. Okay? So if I do this calculation for emerging market, that is 9 minus 21, 9 return plus 21 standard deviation, this is going to be from 50% to minus is 9 minus 41 minus 42, so is 33%. So this is the range. I could be incredibly lucky and get a 50% in 1 year. We saw it with Hong Kong. Or I could be incredibly unlucky and lose 33% in 1 year. And that's, again, we saw it in Hong Kong. But if I take the bonds, that is 2.5 and 0.15, you get from 2.8 to 2.2, basically. So yes, there is uncertainty, but the uncertainty is between 2.2 and 2.8. Okay? So I'm not really afraid of that uncertainty. Does it make sense? Okay, so the idea is not all the asset classes are the same. The probability of being wrong, the sample error, all these things are not equally important for every asset class. And the less volatile is an asset class, the less important they are. And so would be a much smarter idea, instead of applying the same constraint to every asset class, to do something a little bit smarter. For example, we could use differential constraints. And we can say, look, maximum weight is equal to 100% for the safe bond, 30% for the bonds that look a little bit riskier, and 20% for every asset class. For example, if I do that, I'm going to get something like this. And this makes much more sense. It makes more sense because the safe portfolios, the portfolio in the low risk portion of the frontier, are still heavily invested in shorter bond because there is no risk there. So I'm not afraid. But when I come to the higher risk portion of the frontier, I'm imposing a lot of diversification because I'm saying no more than 20% in any equity asset class. Okay, does this make sense? The logic? Now, we could do this. So theoretically, we could survive by saying, let's just give differential constraints to asset classes where the constraints is based on the volatility of the asset class, how risky it is. And we could do that, but there is a problem. And the problem is that we need to make a lot of choices. Which asset classes and which constraints? How many levels? 2 levels, 3 levels, 4 levels? Should I use the same constraint for high yield corporate bonds that have a volatility of 16% and emerging market bond that have a volatility of 8%? Should I use the same constraints for this, or should I use different constraints? So there are lots of choices that we need to make. Now, a resampling is basically an algorithm that is going to make these choices for us. So the result of resampling is going to be something that looks like roughly like this, but the constraints are chosen automatically by the algorithm, and they are going to be more or less proportional to the volatility of the asset classes. The more volatile is an asset class, the more constraints it's going to be. The less volatile is an asset class, the less constraint is going to be. Okay. Now, first of all, let me give you the result. So everybody loves resampling because it gives you something that is A, very well diversified. It's much more diversified than before. B, it looks cool. So it gives you this wavy pattern that people love. Okay, it looks organic, so you don't get these weird jumps and kinks that you get here. You get something that looks much more organic. Okay. Okay. Now, as I said, resampling, when you look at it and you try to describe it, is very difficult to describe. And by the way, one of my standard questions for the exam, standard doesn't mean that it comes every year, but it comes every so often, is try to explain resampling to somebody who doesn't know what finance is. Okay, and it's very tricky. Okay, so how does it work? First of all, it's a Monte Carlo simulation. A Monte Carlo simulation is what you do in finance, where something is too complicated to be modeled mathematically. Say, okay, let's just run 100,000 simulations and take the average result of what we care about. Okay, so that's the general logic. And if you want the TLDR, really the one sentence or the two sentences description is the following. We're going to simulate a large number of statistically consistent investment scenarios. So we're going to simulate a large number of statistically consistent possible futures. And then we are going to take the average efficient frontier of all these 100,000 futures. Okay? Now, let's keep these two sentences in mind. So we're going to simulate a large number of statistically consistent investment scenarios or statistically consistent futures. And then our final frontier is going to be the average of these ones. Now, let me give you the step-by-step, and then we try to see why it works. Okay, the step-by-step is the following. We take our inputs for our mean variance optimization. Okay, so we take our vector of expected returns that we have built using dividend discount model or CAPE or sum of parts or whatever. We take our variance and covariance matrix. Okay? Then we simulate. Sorry guys, can I help you? Can I help you? Okay. So we are going to simulate a possible investment scenario. Now, a possible future, let's assume that our investor has an investment horizon of 5 years. Okay? So a possible future is 5 years of returns from every market that we have in our sample. Okay? So in your assignment, you will simulate 5 years of returns for large cap US stocks, small cap US stocks, UK stocks, Japan stocks, Singapore stocks, whatever, basically all the markets, all the asset classes. So for every asset class, we simulate 5 years of returns. That's a possible future. They could go up, they could go down. It's a possible future. Then, given these 5 years, we are going to take the average return and the standard deviation of these asset classes in this possible future. Could be very similar to the initial one, or very weird if the future is weird. Okay? But we are going to take the mean return and the variance covariance matrix in this future. And then we are going to calculate the efficient frontier in this future, the Markowitz normal frontier in this future. Okay? This would be the best possible portfolios if these futures, if this specific scenario comes to be. Okay? So, I repeat, we simulate a scenario where every scenario is, for example, 5 years of returns for every market. Based on the mean return and the variance of each market in this scenario, we're going to build the optimal efficient frontier, the standard Markowitz frontier. And then we are going to save this frontier. Then we are going to repeat this 10,000 times, 100,000 times. And then our final frontier is going to be the average of all the frontiers. Okay? Now, why does this thing work? Let me try to give you the intuition. Okay? With just a little bit of, just a little graph. Okay? So, in every scenario, let's assume that there is a scenario where, remember that emerging market has a distribution with a mean of 9.25, and we said if we take plus and minus 2 standard deviation, this is going to be plus 50, this is going to be minus 33, something like this. So it's a pretty wild market. Could either be, could go very well and very poorly. Okay? So we simulate a scenario, and let's assume that in this scenario, emerging market is very lucky. So we're going to get mostly good result. So we're going to get 5 results that are all pretty good. And so the return of emerging market in this scenario is, on average, 18% per year. Very good. Not extraordinarily good, but very good. Okay? Now, when I do my efficient frontier in this scenario, and I look at the last portfolio, what is going to be the weight of emerging market in that portfolio? Think about the initial scenario. What's going to be the weight of emerging market in that portfolio? If emerging market does very well, what is going to be? How much? 100%. Okay? So, if this scenario happens, probably emerging market is going to weight 100% in that portfolio. But we are not doing this for one scenario. We are going to do this for 10,000 scenarios. So let's assume that there is another scenario where instead emerging market does pretty poorly. And most of the 5 returns are pretty bad. So return of emerging market in the second scenario is minus 5%. Bad, but not obscenely bad. It's bad, but it's feasible. Okay, we're going to do the efficient frontier again. And we're going to look at the last portfolio. What is going to be the weight of emerging market in this portfolio now? If a portfolio has a return of minus 5, usually what is the weight on the efficient frontier? Sorry? Try a guess. If a risky asset has a negative return, what is the weight on the frontier normally? It can be negative, so it's going to be 0. Okay? So what happened is, I ran 10,000 scenarios. In some of them, the return of emerging market will be very good. And it's going to get 100% on the frontier. In other scenarios, the return is going to be very bad. And it's going to get 0% of the frontier. So, when at the end, I calculate my average frontier as the average of all the frontiers, what's going to be the weight of emerging market in this frontier? If I do the average of all those, what's going to be? I don't know, 50%, 30%? It depends, how many good scenarios we had versus how many bad scenarios. Does this make sense? So this is the intuition. The intuition is, I'm going to run a lot of scenarios. If an asset class is very risky, sometimes it's going to get a very high return and will dominate the frontier. Sometimes it's going to get a very bad return and it's going to disappear from the frontier. So when I do the average frontier, this asset class is going to weight 20%, 30%, 40%, depends on the frequency of good versus bad scenarios. Does this make sense? Okay, opposite case. Let's take just for a second now the first portfolio and let's look at short-term bonds. If shorter bonds come out of a distribution that has a much lower volatility, where you have 2.5, 2.8, 2.2 are the extremes, okay? In this case, very good and very bad scenarios are going to be very, very close. So in a possible very good scenario, it's going to be 2.6%. And I know that normally that will mean 100% of short-term bonds here. A very bad scenario would mean shorter bonds with a return of, let's say, 2.3%. What's going to be the weight on the frontier? Probably something like 95%. Because it's not bad. It's worse than the average, but not very bad. So the problem is, since shorter bonds has a very low volatility, every scenario will have more or less the same return. And so the weight on the frontier is always going to be roughly the same. And so when I'm going to do the average for shorter bonds, the weight is still going to be something like 97%. Okay? So that's why when you look at the result of resampling, shorter bonds still dominates the low-risk portion of the frontier. But emerging market no longer dominates the high-risk portion, is actually now at 20%. Okay? Does this make sense? Okay, so this is the idea of resampling. I repeat, it's very counterintuitive, but the good thing is that once you run the simulation, everything is clear and the code is very simple, and so there is no actual problem in using it. It's just that you get to wrap your mind around this weird thing of creating 100,000 possible futures and then averaging the results. Okay. There are a couple of technical problems that, before we look at the MATLAB code, let me just run through three ideas. One thing, if you look at the resampled frontier, is less efficient than the unconstrained frontier. Okay? Now, this happens all of the time. Every time, because by definition, the Markowitz frontier is the best. That's why Markowitz won the Nobel Prize. Because he said, okay, that's the best way of doing portfolios. You know, the mean variance optimization gives you the highest possible return for every level of risk. There's no way around it. So if we do resampling, we get something that looks less efficient. Now, how do you justify to a client that you are investing on the red frontier rather than the blue frontier? You know, the client tells you, well, why are you putting me on the red frontier? The blue frontier is better. Are you dumb? Don't you know finance? Okay, so how do you answer that criticism? How do you answer that criticism? And the answer is, look, you're giving away a little bit of expected return, like 0.2%, but in exchange of that, you get a lot of diversification. And so you are basically trading off a little bit of efficiency for much more resiliency. Because if you look at this picture, it's completely different from this one. Completely different. You get a ton of diversification, and for that, you only pay 0.2% of return, basically. a little bit of efficiency. Okay? So the idea is that you're trading off efficiency for resiliency. You lose efficiency, but you get something that is much more robust to errors in your forecast. Okay? Number one. Number two is the choice of t. We said t is the length, is usually, let's say, 5 years, for example. We use every scenario as a length of 5 years. Now, the question is, why did we choose 5? We chose 5 because 5 is the expected return of our investor. Sorry, is the investment horizon of our investor. So we said, okay, 5 years makes sense. Now, this is not always the case. What happens if we choose a t that is very long? Again, this is also a typical question on the exam for resampling. Okay? What happens if I run resampling choosing t equal, instead of 5, equal to 50, for example, incredibly long. So every simulation, instead of simulating a future of 5 years, I simulate a future of 50 years. What happens? Think about what's going to happen to resampling if you use a t, so your length of every scenario, instead of being 5 years of possible returns, is 50 years. What's going to happen?
The variance between scenarios will be a lot smaller.
Exactly. Every scenario is going to be equal to the other ones. Because 50 years is long enough that resampling is useless. Because if you invest for 50 years on a market, you for sure are going to get your expected return or something very close to it. Because basically, if we go back to our bad graph, you're going to pick 50 numbers out of this distribution. And 50 is a sample that is big enough that you are going to get something very close to the average. Okay? So running resampling with t equal to 50 doesn't really make sense. Usually you always run resampling with a t that is lower than 10, 5, 6, 7, something like that. Okay? Otherwise, it just makes no sense. Okay. Okay, finally, I just need to do a tiny little bit of statistics just to show you one thing that, again, has no bearings on running the code or anything, but is good just to remember this thing because it shows you that resampling is much smarter than what you think. If you remember, when I said keep in mind that these two concepts, we said resampling is based on the simulation of a large number of statistically consistent investment scenarios. Now, what does it mean statistically consistent? We need to understand that. Okay? Again, let me use just a plot for a little bit of intuition. Think about two stock markets. Equity USA and equity Europe. Okay? What is the correlation between these two markets? Can you guess? What is the correlation between these two markets? Try a number. Give me a guess. Sorry? Okay, less than 1, that's an easy one. I can also tell you that it's higher than -1. Okay, that's also good. Anybody guess a guess? Sorry? 0.8, 0.9, something like that. Okay, so it's very high. That basically means that they tend to move more or less together. Okay? So up to this point, we said, look, we're going to simulate 5 numbers from the US, and then we're going to simulate 5 numbers from Europe. Okay? But the problem is, what is the probability that my 5 returns for the US are all very good, and my 5 years from Europe are all very bad? So what is the probability that the US goes up a lot and Europe goes down a lot? Is almost non-existent. Okay? So to be statistically consistent, I cannot simulate 5 years from the US, 5 years for Europe, 5 years for Japan, 5 years. I cannot do different simulations for every market because I'm going to lose the information that markets are correlated. Okay? So technically, what is going to happen is that we are going to do only one simulation, and we are not going to say market 1 is normally distributed, market 2 is normally distributed, market 3 is normally distributed. We're going to say these 10 markets jointly together, they have what is called a multivariate normal distribution, MVN, multivariate normal distribution. And multivariate normal distribution basically is a very complicated statistical terminology to say something very simple and say, look, every market is normally distributed with its own expected return and its own standard deviation. So every market is a normal distribution, but they are all connected by a correlation structure. They are all connected by a correlation structure. Okay? And so, again, mathematically, that I don't really care about, you say the vector of the 10 returns for the 10 markets as a multivariate normal distribution when every market has an expected return, so this mu in bold is a vector of 10 expected returns, and then there is a variance covariance matrix with all the covariances together. Again, complicated statistical stuff, don't care, I care about the intuition. The intuition is the following. Here you have two plots of two markets, X and Y. Okay? These are examples of the so-called bivariate distribution or bivariate normal distribution. Okay? So X and Y, X has a return of 10%, expected return of 10%, and a standard deviation of 20%. Y has a return, a mean return of 5% and a standard deviation of 10. This doesn't change. It's the same in both the left graph and the right graph. X and Y are the same. So the normal distribution of X and Y doesn't change. The only thing that changes between the two graphs is the correlations between the two. In the graph of the left, we are running a multivariate normal distribution where between these two markets there is a correlation of 0.8. That's more or less similar to what you have between US and Europe. And as you can see, if I look at the simulated numbers, yes, there is randomness, but when X is low, or negative in this case, Y also tends to be low. It's not always. So here, for example, I have two scenarios when X has a return of minus 0.5, and I have very different results for Y. In this case is 0.02, in this case is 0.04. So it's not, the correlation is not 1. But it's pretty strong so that when X is high, Y tend to be high as well. When X is low, Y tend to be low. And so you clearly see that there is a positive correlation. In the second graph, instead, I've used the same two variables, X and Y, same expected return, same standard deviation, but a negative correlation. That is less strong and is negative. So as you can see this time, when X is high, Y tend to be low, and vice versa. Okay? So again, this is just to help you to keep in mind that what we are going to simulate is not 10 individual normally distributed markets, but it's going to be one gigantic multivariate normal distribution where we assume that every market is normally distributed with an expected return and a standard deviation, but they are all connected by a correlation or covariances or whatever you want. Okay? Again, this is not really relevant for the code. The code will go in itself, but it's important to keep in mind that when we say that the markets are, that every future is a statistically consistent investment scenario, it means not only that the expected return, etc., but also that the correlation structure survives, is respected. Okay? Okay, so that's it. So now we're going to do a break, and then we're going to open MATLAB. So in the meantime, download the data, open MATLAB, and do all that stuff. Okay, so if we go to the MATLAB files, you will see that today we have a bit of okay, so today we are going to see something a little bit new, in the sense that for the first time we are going to use a little bit some user-generated functions. And the idea is that you will see, to run a resampling in MATLAB, we need 10, 15 lines of code. That is not much, but at the same time is not super easy every time you want to run resampling to type 10 lines of code, or keeping a file open somewhere where you can do cut and paste, copy and paste, etc. is a bit of annoying. So what we're going to do is, to see how resampling works, we're going to run it once, and then we're going to create a function that we're going to call resampling, that basically does a resampling for us. Okay, so we don't need to worry anymore, and we will just call that function, and with one line we're going to run resampling. Okay, so if you open robust.mlx, by the way, before we start, one of your colleagues came to me asking how should we organize the files for the assignment. Okay, so the official answer is that I don't really care, as long as when I see your assignment and I see that your expected result or expected return for Japan is a weird number, I can understand where, I can go and find out where that comes from. And I can run your code and see that your code in fact produces an expected return of 3.2% or whatever. Okay, so as long as I can do that, I don't care the way you do your files. Now, what I think, sorry, I'm doing a brief interlude before we do resampling. What I think is pretty cheap would be simply to take my files and just change the data at the beginning and run them 20 times, you know. And you can do that. And you can get 7 markets, 3 forecasts for every market, so 21 files. You can do that. You can have a file called DDM US large, DDM US small, Cape Japan. You can do that, okay? It's perfectly fine. My suggestion is, especially if you want to learn to code, just, first of all, get away from MLX files and use M files, so you have more flexibility. If you take the group exercise that we didn't have time to do last week, but I uploaded the solution, if I can just open it a second, I'm gonna go in last week directory. Basically, is the one that I sent you by Slack this morning. Okay, so here, for example, I'm calculating the DDM for Australia. Okay, now, first of all, you will realize that you can get rid of a lot of junk, like you don't need the plot, you don't need a lot of stuff. So probably you can reduce all this code to probably 10, 12 lines, maybe 10, maybe less, maybe 8 lines. You just need these 3, then you need these 4, yeah, probably 8 lines, okay? Now, either you, I mean, if you want to be very cool, you could have a function that changes automatically the name of the market, and that takes time, okay? And maybe it's not worth the effort. But you take these 8 lines and you simply repeat them 7 times, changing the market every time, and you have one file that is called DDM that does all the 7 DDMs for the 7 markets. And then you do the same thing for CAPE. That makes it a little bit more easy because you only have 3 files. Again, I don't care, you can do 21 files if you want. It's just not particularly elegant, okay? And the other thing would be to have, on the other side, one file for every market, one file US, where you copy the DDM part, the CAPE part, the sum of part. Again, becomes a 21 lines file because you get rid of all the graphs and the stuff that you don't need, okay? So keep in mind, again, I don't really care, so do whatever you want. It's not going to affect your valuation, your marking, but try to be efficient in the way you do things. Okay. Having said that, so let's start with the file for today. So today we are going to load a data set called resamp that basically only has 2 variables, a vector of expected return and a variance-covariance matrix for these 10 asset classes. This is very similar to what we had in the slides. I just dropped a couple of asset classes like Italy, etc., because they are a bit ridiculous. So let's run this section just to load the data. Okay. So I have my vector of expected returns. As you can see, they are basically the same. So bond short term has a expected return of 2.56, and equity emerging market has a return of 9.25. So it's exactly the same set that we used in the slides. And then there is a variance-covariance matrix. That is a bit difficult to interpret, but the numbers make sense and are the same volatilities that you have in the slides. Now, we don't really need to do this, but we do it just because we want to be able to look at the difference. So the first thing that we want to do, again, this is not strictly necessary, but we want to run the unconstrained frontier, so just the normal Markowitz frontier, and see what happens. Okay? So, we know most of this stuff because we've done it a couple of weeks ago. So the first thing that we need to do is to take exp and covar out of the tables. Remember that the portfolio functions in MATLAB don't like tables. They want vectors and matrices. So we need to get the data out of these 2 matrices. And the way you do it is to create another variable that in this case for me is just the lowercase version, where we use curly brackets, and then we say, give me every row and every column. So we want all of the data, every row and every column, but basically we just want the numbers. We don't want the names and all the other stuff, okay? And then we are going to create the portfolio object, where, as we know, I'm keeping the same format that we used together in class 2 weeks ago or 3 weeks ago. You could do more efficient stuff, but for now, just to keep it consistent, and also because probably I did copy and paste, I keep the same format. So we create a portfolio object passing only two values, the expected returns and the variance covariance. So port is equal portfolio, where we pass asset mean is equal to exp, and asset covar is equal to covar. So we pass the vector of expected returns and the variance. Then we update port by adding the lower bound and the sum of the weight. So we want lower bound equal to 0 for every asset class and sum of the weight equal to 1. So port is equal to portfolio. Remember that portfolio is the MATLAB function with which we create the portfolio object. And then every time we want to update it by passing another variable of some sort, we need to use port equal portfolio, then we pass the old one, so start from here and add these other parameters. In this case, lower bound, that is the minimum weight for every asset, is equal to 0, and budget, that if you remember is the sum of the weights. then, if you remember, we want to pass the names of the asset classes, so it's going to be easier later on to do plots and stuff. So we take the names from the vector from the table exp. The table of expected return here, if you see, has the names. For every column there is the name of the asset class. And so we say, look, names is equal to exp dot properties dot variable names. So we get the names. Bond, short-term, bond, Europe, etc. And then we pass these names into port using the asset list. Basically, we say, look, these are the names of the asset classes. So keep them there. We are going to need them later. And then finally, we can simply estimate the frontier. And we are going to plot the result. So let's run this section. And then we are going to comment a bunch of stuff. As I repeat, this is all stuff that we have seen in week 2, so you can go back and check. Okay, so first of all, the plot, if you remember, is an area plot that we do using the matrix of the portfolio weights. In this case, the matrix is called PWGTU, so portfolio weights unconstrained. And then we put the legend, and the legend is the names of the asset that come from portfolio asset list, where we put them. And then everything here is kind of useless. So what you have here is we give the axis that start from 1 to 20, the horizontal axis, and 0 to 1, the vertical axis, so the plot looks nice. We put the grid. Since the plot is a surface, we need to put the grid on top of the graph, so that's this line. Title. Color map jet is just to get a color map that goes from blue to red and yellow. Otherwise, you get a standard color map that is a bit, I mean, you can use it, I don't like it. It's all just variation of blue and yellow, so it's not very clear. Anyway, it's exactly the same graph that we had in the slides with different colors. So again, the dominating asset classes are equity emerging market and bond emerging market. So far, nothing new. So this is not resampling. This is the normal efficient frontier. Just to show you what happens if we run Markowitz here. We're going to have trouble convincing any investor to buy into this. Okay, so let's try the constraint or constraint frontier. There is a typo in the title. Okay, so let's assume that we are very cheap, we don't know resampling, we just want to use some constraints. And the constraints that we're going to use are of 3 types. We're going to say, look, since the problem here seems to be bond emerging market and equity emerging market, let's put constraints on these 2 asset classes alone. Let's see what happens. If we just constrain this one and this one, the green and the yellow one. Okay? Good. So we are going to put 3 constraints. We are going to say bond emerging market lower than 30%, equity emerging market lower than 30%. And then, since we can do it, and I wanted to show you an example where it would make sense, we can also add a 3rd constraint that is a bit different, that is bond emerging market plus equity emerging market lower than 50%. Okay? So not only a constraint on each one of them, also a constraint on the sum of them. Just to see how it works, do something different. Okay, we're going to create a vector of lower bounds that is 0, 0, 0, 0, 0, so lower bound is still 0. If you don't like to type so many zeros, you could use alb equal to zeros 110, so that will create a vector of zeros of size 110. Then we are going to create upper bounds. and upper bound is going to be 1, 1, 1, 1, 0, 3, 1, 1, 1, 1, 0, 3. Okay? I know that my two asset classes are asset class number 5 and asset class number 10. Okay? I could have written a 10 lines of code where it says go and check the name and look if the, but it is overshooting. Asset class number 5, asset class number 10. We're going to do this. Okay, and then we are going to pass lower bound and upper bound to portfolio. Okay, so again, port is equal portfolio. We import the old one, and then we have lower bound is equal to LB, upper bound is equal to UB. Okay, now finally, we need to add this new constraint that is the group constraint. So this third constraint is called a group limit or a group constraint because it's a constraint that is not on a single asset class, but on the sum of a number of asset classes. In this case, the sum of two asset classes. And the way you do it is very easy. You need to pass a vector with the group composition. And the group composition in this case is equity emerging market plus bond emerging market. So asset class number 5 plus asset class number 10. And the way you pass that is with a vector that is basically a group membership. So in this case is 0, 0, 0, 0, 1, 0, 0, 0, 0, 1. So basically this is telling the group membership of the group. Does it make sense? And then we pass group matrix, group, so this vector, and then we pass upper value and lower value for the group. Upper group is 0.5, 50%, lower group is 0. So basically saying, look, the sum of these two markets, the sum of market number 5 and market number 10 can go from 0 to 0.5. Does it make sense? If you have multiple groups, this thing called group, instead of being one single line, is going to be multiple lines, where every line is membership in one group. Okay? I could have another line with another group that is all the UK asset classes, all the euro-denominated asset class, whatever you want. And then you pass multiple use upper group and lower group. Okay, so now that we have passed the constraints, we can run another frontier that we will call PWGTC, so portfolio weights constraints, and we can plot. The plot is the same. Let me run this section. Okay, so this is my constraint frontier. Now, do we solve the problem? More or less. Now, first of all, notice that you can see in the frontier when a constraint becomes binding. So let's take bond emerging market, the green one. We say no more than 30%. So as you can see, bond emerging market starts from 0. Can I move the table? No, okay. No, don't do anything. I don't know what this is. Okay. So, bond emerging market starts from 0, then it starts growing organically, keeps going up and up and up to this point, portfolio number 10. From this point, clearly, the constraint 30% becomes binding, because you see we are almost 30%. In case this is basically 30. So, from here on, we are stuck at 30. 30, 30, 30, 30, 30, up to this point where, as you can see, in this case, what's happening here is that bond emerging market goes below 30%. In this last portfolio is lower than 30%. And we say, why does it go lower than 30%? Well, because equity emerging market is going up. And so in this case, the group constraint becomes relevant. Because not only this has to be at 30%, but this plus this has to be 50%. So if this has to go to 30, this has to come down. Okay? So anyway, so these are constraints. Again, does it solve the problem? More or less. But now that we have no longer the problem of equity emerging market, now we have the problem of equity Japan. So we should also add a constraint on equity Japan, etc. So again, you can keep adding constraints, and you would find a solution that is well diversified. But you need to make a lot of choices, etc. Why don't we get an algorithm that does it for us? So let's do resampling. Okay, now as you remember, I said we should repeat something 100,000 times. So normally when you do resampling, you're going to repeat how many random scenarios you're going to create, 10,000, 100,000. Now here, I don't want to do that because it's going to take a few minutes to run the code. So we're going to do 500. But if, as it happens every single year, I get a group who sends me the assignment with 500, you're going to lose points. Okay? Because when you do Monte Carlo, you need to do at least 10,000. Ah, but it's too slow. Well, go and get a coffee. And then you come back. Okay? Good. So how many iterations? Let's say 500 just to keep it fast. How long is it? What is the length of every scenario? 5 years. Okay? Okay, so now this thing has my resampling. So as you can see, resampling is very small. It's like 1, 2, 3, 4, 5, 6, 7. It's 10 lines of code altogether. Okay? How does it work? First of all, we are going to create an empty matrix for my portfolio weights. We are going to create a matrix called PWGTR, portfolio weights resampled, full of zeros. Okay? So the matrix now is zeros. What size? Well, look at how many rows there are in the covariance matrix. That's 10, I think. How many columns? 20. 20 because I'm doing 20 portfolios. Okay? So this is a matrix full of zeros that we will store the results in. Okay. So now you have a typical thing. If you do programming, you know what this is. This is a for loop. That basically means repeat these iterations how many times? N, where N in this case is equal to 500, but in your simulations is going to be equal to 10,000. Okay. So what happens in every simulation? Okay. So the first thing is that we simulate the future. We simulate the random scenario. Okay. Now there are two aspects here. One is the function and one is this weird thing of the 12. Okay, so the function is MVNRND. Okay, so let's look for this function. Let me open the help. If I type MVNRND, I get multivariate normal random number. And that's exactly what we want. Okay, so every function in Excel, in MATLAB, they generate random numbers, usually as a name with RND. Okay, random. So the one that I used 2 weeks ago to generate one random integer was randint. The one that I used today to generate a random permutation of a vector was randperm. If you want to simulate random numbers from a single normal distribution, is norm RND. In this case is MVNRND, so multivariate normal random distribution. Basically means with this thing, different numbers, different entities, all of them individually normals but correlated. Okay? And as you can see, the structure, the syntax is very simple, is MMV RND, the vector of expected returns, the variance covariance matrix, and then if you want, you can give the size, how many numbers you want, how many cases, how many. Okay, so let's go back to our code. Now, normally, I would write a line like this. Don't touch the code. Let me just write one thing. So in theory, this is the line that I should write. So multivariate normal random distribution. This is the vector of expected returns. This is the variance covariance matrix. How many numbers? 5. T equal to 5. Okay? So this is what I should do. Problem is, if you do this, you're going to have some problems. Okay? Because there is a rule in statistics that if you need later on to calculate the mean return and the covariance matrix among these numbers, you want more observations. So we want to keep t equal to 5, but we want more observations. So what we do, we are going to use monthly observations, monthly returns. Okay? So instead of simulating 5 yearly return, we're going to simulate 60 monthly observations. Okay? And the way you do that is, okay, this is basic rules of statistics, or financial statistics, financial econometrics. Basically, if your yearly return is normally distributed with an expected return, your monthly return is normally distributed with an expected return that is the original one divided by 12. And the same is true for the variance and the covariance. They also divide by 12. Okay? So we can simply go from the yearly return and yearly variance covariance matrix to the monthly ones just by dividing by 12. So we generate RET, the vector of expected return, the 60 returns for every market, 60 months, 5 years. Then we're going to calculate the mean return and the variance covariance matrix in this scenario. So X2 is the average of these returns, and cover 2 is the covariance matrix of these 60 returns. Does it make sense? So we are basically taking the average return and the variance covariance structures of the assets in this random scenario. So exp2 and cover 2 have almost nothing to do with the original exp and cover. They could be quite different because this is just one possible future. Now, of course, since here we divided by 12, now to go back to the original scale, we multiply by 12. Okay, at this point, we just do the normal Markowitz frontier. We generate a portfolio object called POR2, where we pass exp2 and cover 2. We pass the default constraints, so lower bound equal to 0, sum of the weight equal to 1. Remember that you can pass it like this. And then we estimate the frontier with 20 portfolios. Okay, so that's it. This is what happens in every scenario. We simulate the random scenario, we take the average return and the covariance, and we do Markowitz. That's it. Now, remember what we said. At the end, we want the average frontier. Now, in theory, we should save every frontier. Now, saving the frontier is very space intensive because every frontier is a matrix with 20 portfolio and 10 assets. You don't want to be having to store 100,000 of those. But you don't need it. Because in reality, the only thing that you need is the average. And so what we are going to do, we are going to use a trick where basically in every iteration, we are going to sum the weights to the previous ones. We will keep summing and summing and summing. And at the end, we divide by 10,000 or by 500 in this case. So we get the average frontier. Okay? It's a bit counterintuitive, but is statistically much more efficient and saves a lot of space and a lot of time. So instead of storing in memory 10,000 different frontiers, every time we just store the sum of all the frontiers, and then we divide by 500 to get the average. Okay, so trust me, it works. Okay, so let's run this section. I should have run it before. So okay, so it has finished, so it's not too bad. Now we can simply take this gigantic frontier that is the sum of 500 frontier, and we can divide by n or by 500. Now, just for your mental sanity, if I go here and I double click in PWGTR now, you look at the numbers, make no sense at all. Okay, it's 400, 490, 27. These are not weights. Weights goes from 0 to 1. Okay, if you open the unconstrained frontier, all the weights go from 0 to 1. Okay, so these things with weight in the range of 500, 11, 22, 34 makes no sense, because this is the sum of 500 frontiers stacked together. So what we need to do is simply to divide by 500, and then we can plot. So if I run this section, boom, I get my resampled frontier. Okay? So as you can see, even with 500, it looks very good. Now, what happens is that since we only did 500, if you go with a magnifying glass, you will see that each one of us has slightly different frontier. Slightly different. Your green must be could be a little bit fatter, a little bit thinner, could be slightly different, because we only did 500 simulations. But if we had time and each one of us did 10,000, then we will all see the same frontier to a very, very small precision level. Okay? And again, there is no denying that when you talk to investors, this thing looks much, much better than this thing. Okay? It's just more, how can I say? Okay, here I don't know why it keeps. Okay, I don't know what I'm doing. This, okay, you get the point. Yeah. Okay, it looks much better than this one. Okay, so as you can see, resampling is relatively straightforward. I repeat, it gets a little bit of time to get used to the to the process, but once you look at it, it makes a lot of sense. You generate a random scenario, you calculate a mean and variance covariance, you run Markowitz, you save, at the end you do the average, and what you see is exactly what you want. Safe asset classes still dominate the frontier, risky asset classes get heavily diversified. Okay, now how good are the three frontiers? Remember that when we run estimate frontier, we only get the weights. Can we plot the frontier with the expected return and expected risk? Yes, if you remember, there is a function called estimate portfolio moments, where you pass the object port and the matrix of the weights, and you get risk and return for the 20 portfolios. So we do the same thing for the unconstrained, the constrained, and the resampled. And then we can plot the three frontiers. and I get my 3 frontiers. Okay? So the unconstrained is, of course, the better. The constraint is a little bit in the middle, and the resampled frontier is quite lower, but always with this idea that we are trading efficiency for resiliency. And so we are saying, dear client, with the expected returns that we have, if you want an expected return above 8%, you need to bet the farm on emerging market, because that's the only market that can give you more than 9% in terms of expected return. I suggest you don't do that. I suggest you diversify more. So I suggest you get happy with an 8% return, but it's an 8% expected return that comes from a very well diversified portfolio where you are basically investing all over the world and is much safer, blah, blah, blah. Okay? So that's the idea. Okay, so now we have seen a resampling run once, and we know that basically resampling is these 10 lines. Good enough, but it's a bit of a pain every time having to type these 10 lines. So what can we do? Well, you have a file in your directory called resampling.m. Let's open it. Now, resampling.m is an M file. So, first of all, it's a weird M file because it opens with a special line, with a special word that is function. Okay? So this is what you do when you want to create a function in MATLAB. We used a lot of functions, like min, cov, red to tick, all these functions that we have. Okay? Now, when you have a function in MATLAB, means that somewhere in your MATLAB directory there is a code, there is a file called min.m, redtotick.m. So every function in Excel is saved into an M file with the same name. And so you can create your own functions. You just need to create an M file that does the calculation. There are some rules. Rule number 1, the file has to start with the word function. By the way, when you type it, immediately becomes blue. Then, the first line has to have the syntax of the function with the output equal to the name of the function and then all the inputs. The other important thing is that the name of the function has to be the same as the name of the file. So the file is called resampling.m. And the function in the first line is called resampling. The other thing that you need to remember is that when you do all the calculations, at the end you need to have an output that in this file has the same name of the output here. So the output is going to be pwgt, that is the same here. Okay? Now, if you look at the function, it's exactly the same lines of code that we had in the MLX file. I just copy and pasted them here. It's exactly the same lines of code. Okay? So let me go for a second in the normal MATLAB thing. Okay, so let's assume that I want to do resampling. I should type the 10 lines of code. Or I could do something different. I could say, look, resampled, this is my output, for example, is equal to resampling. So I'm using the name of the function. Then open parentheses. Okay, so first of all, what happens is something very interesting. You know that in MATLAB, when you start typing a function and you open the parentheses, you get some help. And the same thing happens with your user-generated functions. You open the parentheses and you get the syntax of the function that the file is taking from here. You get this syntax. That's also why it's good to give names to the variables here that make sense and are easy to read. Okay. Now, if you click on more help, I think that, okay, if you click on more help, nothing happens. Okay, weird enough, there was a function called resampling in an older version. Okay, I should have changed the name. So don't click on more help. If you need help on the function, I put here some indications of what the items are. But, so resampling. The first thing that I need to put is the vector of expected return, exp. The second is the variance covariance matrix, cov. The third is the number of random scenarios, 500. Again, remember 100,000, 500. Then the third is the length of the simulated period. How long is every scenario? 5 years. And the last is how many portfolios do we want? We were doing 20, let's change, let's do 25. Just to do something different. And then I'm going to do enter. What did I forget?
Covar instead of cov.
Ah, covar. Okay. That's the biggest issue, is every time I type a covariance, I call it cov. Anyway. Okay, so I go enter. Now, everything is frozen because it's doing the resampling. So we wait. Boom. So now I have my resampled frontier. If I want to plot it, sorry, I can do area of resampled transposed, and I get my resampled frontier. Okay. By the way, you see that's why when you do resampling, the resampling graph in the original code, they have that weird line, set GCA limits 110.01, is because otherwise, if you do area, for some reason starts from 0, and the vertical axis goes to 1.2, so it looks really bad. Anyway, so you have the code. But the most important thing here is to remember, so you can do resampling with basically one line. This thing here, okay? So this is the only thing that you need to do resampling. One caveat. The function resampling, so the file resampling.m has to be in your directory where you're working. So you need to keep bringing that file around wherever you're working for your assignment, etc. Now, technically, there is a way to tell MATLAB, look, take this file and put it in the central repository of all the MATLAB functions, etc. Don't do that, you're going to get lost. You will not find it again, then your MATLAB updates and that function is cancelled. So let's keep it in your directory, that's the easiest thing. Then, so that's it, okay? So we could finish here. There is only one caveat. You will find another function called resampling con. Do you have it in your file? Did I give it to you? Yeah. Okay, so resampling con is a weird function that I had to use because 2 or 3 semesters ago, there was a problem with expected returns. There was one market, that was the market at the time we used for emerging markets. Now you have Singapore, you shouldn't have any problem. But 3 semesters ago, we had a market that had an incredibly high expected return. Was like 4 or 5 points above the others. So even resampling was not able to manage that situation because it was just too far away from the other. So what I did is to create another function. This is a weird version of resampling. It's not really used in the industry too much, but just for your general knowledge. Basically is resampling, but where in every iteration, in every possible future, we say, look, no matter how good that market is, I want no more than, let's say, 30% in that market. Okay? It means in every future, in every possible future, even if that specific market goes to plus 300%, I want no more than whatever, 30% of that market in my sample. So very likely you will not need to use it, so you can forget about it. But just in case, if you find a situation where you have one weird market that it doesn't work, that even with resampling dominates the frontier, what you can do is doing resampling con. So first of all, you're going to create a matrix, a vector called upper or constraints, const, for example. Let's say that is my last market as usual. I don't think I have enough, but it doesn't matter. I don't want to run it. Okay, I'm going to create this const. Then I'm going to use resampling con that works in the same way, but at the end, you also need to pass this constraint. And that basically is going to run a resampling where in every scenario is going to cap that specific market to 30% or whatever you want to cap it. Okay? Again, I'm 99% sure that you should not need it, but that's what you do if even your resampling is not powerful enough to control a market. If a market is an extremely high expected return, I would very much prefer that if one market has a very weird expected return, you discuss that possibility in the assignment and you find a solution within your methodologies. Saying, look, maybe sum of part cannot be applied to Singapore because if I apply sum of part to Singapore, I get an expected return of plus 25%, and that makes no financial sense. Okay, I very much prefer this solution, but just in case, that's an alternative. Okay, so that's it. As usual, you will find what is called the group exercise, group.m or something like that. Do it as a homework, and I will upload the results in a couple of days. Okay, or I can also upload them tomorrow. It's just to help you to work resampling into the assignment data, so it's a good exercise. Do it individually. Okay, thank you very much. If anybody has issues with the assignment code so far, I'm here for the next minutes. Thank you very much. See you next week.